Alright, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we're going to answer the age-old question of when to buy a stock. Equally importantly as when to buy a stock, we're also going to be having a look at a couple of things to help us decide if a stock is worth buying or not, and then if it is, we're going to look at when exactly we should buy the stock. Now, just keep in mind, guys, none of what you see in this video is financial advice, okay? So this is basically me just showing you guys what I like to look for when I decide, first of all, if a stock is worth buying, and if it is worth buying, when I should actually get into the stock, okay? So before you guys do any sort of buying or investing or whatnot, you guys should always do your own research and talk to a professional. So in order to discuss and decide when to buy a stock, first of all, what I wanted to take you guys through is the market, okay? So the general market sentiment and psychology as to when they get really excited about a stock or when they get really, really depressed about a stock, okay? Because as cliche as it sounds, you want to be doing exactly the opposite of what the masses are doing, okay? So if these sheep and lemming are jumping off a cliff, then you want to actually be, doing the exact opposite of that. So what I have for you guys here is basically the common or the typical market psychology of your common retail holders when they invest in the stock market, whether it be buy or sell, right? So it fluctuates from optimism all the way up to, cloud nine euphoria, down to the pits of hell, past capitulation when, everything is terrible and the world sucks, and it sort of fluctuates along that curve. And so I've highlighted for you typically where you might want to start buying a stock if you find it is worth buying at the bottom of this V-shaped curve over here. So that sort of sweet spot down the bottom there is where I typically like to initiate a buy position on a stock. Okay, and what I like to call this style of investing or buying, if you look at these cute little animals to the right, bottom feeding is basically my style of investing. If you guys aren't familiar with these cute little animals to the right-hand side, they're basically bottom feeders, right? So what they do is they lurk along the seabeds, waiting for the sharks and the predators and all these big fish to, rip up all these juicy pieces of meat, and then whatever it is that falls to the bottom, they then pick it up. Not much work, not much risk. They just sort of lurk around and eat the scraps. But then in the investing world, occasionally what you get is you get some nice big chunky pieces of meat. Maybe the predator ate too much and couldn't be bothered, or maybe they were too busy focusing on the fish that they forgot the chunks being ripped off. Anyways, guys, you get the idea, okay? So what I like to do is I like to sort of lurk at the bottom there, just waiting for a really, really good deal to come my way. All right, guys, so what I wanted to take you through now is the two types of bottom feeding that I like to do. And I like to classify my bottom feeding into two sort of main buckets, right? You've got your easy money blue chip bottom feeding, where you get these really good, solid blue chip companies, nothing wrong with them, good management team, good performance, good track record, good everything. And then for whatever reason, some type of news comes out and then they fall off a cliff, right? So they drop 20, 30, 40%, all on the back of some very, very trivial news that the market has, I guess, fortunately or unfortunately, depending on who you are, blown out of proportion, which then provides us as bottom feeders a very, very good entry point to get into the stock, okay? These blue chip companies. We'll talk about that in a little bit. And then we've got what I like to call the contrarian play. So the contrarian bottom feeding style, which focuses on your sort of, small to smaller mid-cap companies, $500 million to $3 billion. Okay, guys, so let's start by talking about the easy money stocks, okay? So the blue chip bottom feeding. And I'm just going to use Facebook, Apple, and Google as very simple examples. And the reason being is because these companies have done well over the past. They'll continue to do well in the future. And they're very, very unlikely to be dethroned or knocked off their current trajectory just because of their competitive mode is so strong and their ecosystem is so wide, okay? Now, obviously, I have a lot of other stocks in my blue chip bottom feeding list, but these three are just sort of the classic examples that I like to use to demonstrate this analogy, okay? So let's start off by using Facebook. So what should we look for when we're bottom feeding with blue chip stocks, okay? So what I typically look for is news that drives the stock down 25 to 40%, which has no material impact. Okay, so this is very important. No material impact to the long-term health of the business. So what we're looking for is noise. We're looking for people overreacting. We're looking for people doomsdaying. We're looking for people just panicking, and we're just looking for things which are very, very small, little molehills that blow up into mountains that causes a stock price to have a sharp decline over a short period of time. And this is gold, right? And so the sentiment when this happens to the stock is very important. So what I like to look for is the average trading ranges, okay? I want to look at what the stock typically trades at when the market is optimistic, and I want to look at what the stock trades at when the market is pessimistic, and sort of get an idea of a range of sort of the price multiples that it trades at, which then gives me an idea of a good time to enter or maybe stay away from the stock, okay? And what I then want to look for, following the fact that there's a little bit of panic, is factual evidence, okay? So not anecdotal, not somebody's feeling, not somebody's guess, factual, solid evidence that the business will be fine despite the seemingly very, very negative news. Then what I want to do is I want to hop onto the next earnings call or the next two earnings calls. And I really want to listen to management, right? I want to listen to what their tone is. I want to listen to how confident they are. I want to listen to how conservative they are. I want to listen to what they're worried about and what they're not worried about, okay? And then I want to then compare all of that to the news that I have. And if I find that the stock has fallen for very trivial reasons, then simply I just buy, I wait for 3, 6, 9 months, and then I sell. Okay, very simple. So easy money. Now, just a little point here. So blue chips that are really, really good quality companies, like your Facebooks, your Apples, your Googles, they don't usually tank more than 50% unless there's something seriously wrong with the company, or there's some big problems, or there's some trouble around the corner, or the whole market has crashed, right? So you look at the dot-com or the 2008 crisis, okay? Now, when a blue chip goes down more than 50%, then that's typically when you should be worried. And a really good example is General Electric, okay? So now there's plenty of stories I can give you, but what I'm going to do is I'm just going to use Facebook to illustrate my example of easy money blue chip bottom feeding, okay? As you guys may recall, Facebook had two very, very sharp declines in the space of about a year and a half, 2 years, okay? The first little circle there, Cambridge Analytica, and then the second one was a bit of a, I guess, not even an earnings blip, but just a slight earnings slowdown, coupled with the trade war and then the fears of Trump and the fears of recession and, you know, all of that stuff, okay? So that pretty much sent the stock off a cliff. Its first drop was about 15-20%, and its second drop was at its most bottom point was about 40%, okay? But as we looked at before in this slide, most of that news was trivial, if not all of it, okay? So let's have a look at what caused the stock to drop, and then let's have a look at why it was trivial. So first thing, okay, Cambridge Analytica, right? So the minute this came out, this was all over the news, all over the headlines, okay? Facebook has lost everybody's trust, hashtag delete Facebook, let's just stop using this, they're stealing our information, they're stealing our data, something, something, something. Okay, Facebook is dead money now. The stock's going to go nowhere. People are going to stop using it. Revenues are going to decline. Its user base is going down. Nobody trusts the platform. Okay, so this seemingly massive deal with Cambridge Analytica, combined with, like I said, their slight earnings slowdown just for 1 quarter, along with the fact that they needed to hire more security and compliance personnel, which was only going to affect the company's bottom line for about a quarter, got blown way out of proportion, okay? And while all this was going on, and people were saying Facebook is dead, nobody's going to use it anymore, blah, 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 it's like MySpace, it's gone, okay? Facebook daily active users going up. Facebook monthly active users going up, okay? Facebook average revenue per user. Everything was basically going up, okay? So, if you looked at the news at this time, it was all over the news, right? It was basically, every day or every second day you get a Facebook article, or every day you might get 10 different Facebook news articles saying things are all over, it's all gone, whatnot, right? But what happened? Well, fast forward half a year, Facebook went back up to about $200, and now it's gone down again because President Trump has put another 10% of tariffs. Okay, so then now I'm going, okay, great. So I bought down here, sold up there. Let's just look at it again, okay? And if it goes down some more, then I'll just buy and then sell it again when, everybody goes back to normal and the cycle repeats itself. Hence, this is why I call it easy money, okay? People panic and then they sell, and then, you stay calm, you wait at the bottom, you decide what's a good entry price to get in, you buy, you hold for a little bit, and you sell it off. Happy days, right? And like I said, guys, I can think of countless examples of where this has happened with other blue chip companies, right? Your Googles, your Apples, your Amazons, basically really, really good companies that are in no immediate danger of going anywhere in the long term. A little bit of negative news gets blown out of proportion because these are blue chip stocks and everybody likes talking about these, and then next thing you know, the thing goes down 20-30%, and then you buy and then it goes back up, and you just keep repeating itself. Hence, this is why I call it easy money, right? I mean, you look at Apple, you had 2 opportunities to do that with Apple in the last year. Google, you've had about 3 opportunities to do this with Google in the last 2 years. So that's why I always keep a nice watch list of blue chip stocks, and the minute that there's a bit of fear, a bit of panic, and things get wrongly sold off, I simply just jump on the bandwagon. Happy days. And so I conclude the first part of the video with a saying called, "This too shall pass," which is a saying that came from Persian. That's saying, look guys, the sun's still going to go up tomorrow, and it's still going to set tomorrow, and the world's still going to spin, okay? So it's not the end of the world, right? Alright guys, so that's part 1 of the video. Part 2, the contrarian plays, okay? So this is a little bit different to the easy money plays, and the reason why I say it's a little bit different is because it requires a lot of work, alright? So you're looking at these companies that are between $500 million to $3 billion in market cap, okay? And typically these companies are companies that will go up massively in a short space of time, but could also go down massively in a short space of time. So guys, the volatility in these stocks are quite high, but the opportunity to get a good return is also high if you know what you're doing as well. But these are significantly harder to do than your sort of blue chip stocks, right? Because these companies, you really have to dive deep inside the companies. Not many analysts cover it, so you have to not only know the companies, but you have to know the industry, you have to know the both micro and macroeconomics, you have to know the sector, you have to know the competitors, okay? So it requires quite a bit more work. But the returns are actually quite handsome as well, like I said, if you know what you're doing and you know what you're looking for. So the criteria, very, very similar to the blue chips, okay? Except what you want when you're looking at these companies, these contrarian small to small mid-caps, is what you really want to be looking for is a drop of greater than 60 or 70%, because the beta and volatility in these stocks are a lot higher, okay? And the other thing that's really important is you have to have a look at either how high or how low the bar has been set, okay? So for example, what is Wall Street expecting? What is the market expecting? How confident are you that management will be able to beat these estimates, okay? What material, again, not anecdotal evidence, do you have that backs your hypothesis, okay? So this is very important. Everything else is the same as what to look for in blue chips. So remember guys, in these types of contrarian plays, what moves the needle is not intrinsic value or discounted cash flow or any of that rubbish, okay? Otherwise, if that is the case, nobody would invest in or make money off tech stocks. What moves the needle is the beating or missing of expectations, alright guys? So I just want to reiterate that one more time. What moves the needle and what drives share price is the beating or the missing of expectations. So I just wanted to share a really interesting quote with you from Barry Schwartz, okay guys? And it's very simple. The secret to happiness in life is having very, very, very low expectations, okay? And a good analogy I can give you is if you're the only person running in a race, you can't lose, and you're going to get the gold medal every single time. And so that's what I mean by contrarian plays, right? So what you want is you want these companies that have been sold off and hated for the wrong reason, but many, many people can't actually see that it's the wrong reason. So they've just sold the stock into absolute oblivion, okay? So what you want are companies where they're going to be okay. They've got a good management team. They're going to do well. They've got a good business model, but everybody hates it, and hence the expectation is rock bottom, and the expectation is very, very low, okay? And the lower the expectation, the easier it is to beat these expectations, and the easier it is to beat these expectations, the easier it is to move the needle and the share price upwards. It's very simple, right? So what you guys really want to look for is you want to look for the dark horse, right? You want to look for the underdog. You want to look for things that will be fine through factual, not anecdotal evidence, but for whatever reason the market cannot see. And then that's when you have a winner. So guys, let's have a look at an example of a company that fits that previous description before, right? And this is a stock that I covered twice in my channel. So if you guys haven't seen the previous videos on Qdian, have a look at the couple of links that I've included in the description, okay? I'm not going to go over it because I've already spent about 100 hours researching this company and I've released 2 videos on it. So if you guys want to see my thesis on that, just have a look at the 2 videos and the links below, okay? But in short, guys, let's have a look at this company, okay? So I started buying Qdian, or Qdian for my friends who can't speak Mandarin, back in April, okay? Back when it was about $5. And so I've built a little sizable position, and I'm happy with it now, so I'm just going to ride the wave and exit when I feel like it's the right time, okay guys? Now, in terms of expectations, so let's have a look, okay? So their most recent quarter, they beat their revenue by $43 million, massive beat, and they beat their EPS by 13 cents, okay? Again, a massive beat. So it was basically a beat on revenue of, over 16-17%, and then earnings beat of over 30-odd%, okay? And then the next quarter, the analysts are only expecting them to do less revenue than the last quarter, with EPS only going up a fractional amount. And so I'm thinking, okay, well this, so this is like, okay, well the bar has been set very low. And as you guys remember, if you've watched my other videos, you'll know that they're easily going to beat these numbers because they recently just released an update which saw their net profit for the year guidance raised by about 30-odd%, okay? So I don't know what the analysts or Wall Street is doing here, but I think that this is a really good opportunity to capitalize, okay? So if you look at the next quarter, they're actually expecting the sales number or the revenue number to go down 11.6% year on year. And then in the third quarter, they're only going to expect it to go up 2.5% year on year. Okay, so that doesn't make sense, right? Because if they're expecting it to go up 14.6% for the whole year, like what are they going to have a massive quarter for? Okay, so this already here doesn't make sense. And so if we look at a couple of numbers that I put together for you, you'll see why I'm even more confident that it's going to be beaten, okay? So this is Qdian's track record of their earnings differential from quarter to quarter to quarter. And if you guys pay close attention to the track record and revenue history of Qdian, you'll actually realize that Qdian has never had a quarter 2 which was less than quarter 1. In fact, on average, the quarter 2 is at least 36-odd% greater than quarter 1. But let's just be conservative, okay? And let's not take the average, but let's say we'll just take the median number, which, as you guys can see by the history, or let's take the lowest number, okay? The lowest number that quarter 2 has been more than quarter 1 was at least about 16-17%, okay? So you'll notice that they increased their loan book by about 20-30%, which means that their revenue is going to go up naturally by a similar amount. And the fact that they've lifted their earnings guidance by 30-odd% for the end of the year, I believe that there is material evidence, along with looking at the revenue trend history over the last 3 years, which supports a very high likelihood of a beat, both in terms of revenue and EPS for quarter 2, quarter 3, and quarter 4. Okay, guys, and hence this is why I built a long position in Qdian. Now, in contrast to this, what I wanted to take you guys through is a company that's unlikely to beat their earnings and revenue for the next 2 to 3 quarters, and have a look at what I'd look for to understand that, okay, this is not a good stock to buy, okay? So let's use Nutanix. So this came across my watch list when obviously it fell off a cliff down sort of, 60, 70-odd% in the last year. So I thought, okay, cool, let's have a look at this company, right? Let's see what's driven it down. However, after a lot of research, I found that it basically it was unlikely to outperform estimates, and that the market in this case is not wrong sending the stock down, okay? And I'll explain why. So let's have a look at their numbers, okay? You can see their revenue has grown consistently, which is good. However, there was a significant slowdown and a backwards momentum of revenue in the second quarter. In addition to that, their sales and marketing percentage of their overall revenue was steady. In fact, it was sort of going down as the revenue was increasing. But then, as you can see, since quarter 3 2018, they had to start ramping it up. And then they had a massive ramp up in terms of sales and marketing expense in quarter 2 of 2019. Yet the revenue went backwards, and the net margin has gone from an improving trend to a negative trend in the space of a couple of quarters. And as you can see, they had basically a disastrous second quarter, okay? And so, first, this should have already been a red flag, okay? If a company is massively ramping up its sales and marketing expense, yet its revenue is decreasing, that's definitely not a good sign, okay? However, what I decided to do was I decided to give the company the benefit of the doubt and do a little bit more digging into the company, okay? So according to their CEO and founder, the reason why they had a backward revenue number was because they had some problems in terms of their sales lead generation and their sales execution, okay? So his excuse was that there was a bit of a shakeup in terms of the sales team. There was a bit of organizational restructuring. They didn't invest in much in terms of sales personnel and lead generation as they wanted to, and hence their revenue, took a dive, right? And he said, look, we've implemented some measures and we've implemented some steps, and we believe that this is going to self-resolve in a couple of quarters. However, when we dig a little bit further into the Q&A section, you'll actually realize the CEO has contradicted himself, because as you can see here in the middle of the page, he said the changes take a couple of quarters to show results. However, when he was queried in terms of how long it takes their quota-carrying sales reps to ramp up, okay, you'll see that there's a bit of self-contradiction. You'll see here highlighted in blue, the average rep takes 4 quarters, okay, to get to full productivity. 4 quarters. Even more importantly, that's the average rep, okay? They're sort of key account managers. So the global account manager, bottom line, okay, take a little bit longer, right? So maybe it's 6 quarters, maybe it's 5 quarters, who knows, okay? But this in itself is a contradiction. So first of all, the CEO says our problem is going to be solved in a couple of quarters, yet we've hired a bunch of new salespeople to address our lead generation and sales execution missteps, and that's going to take at least 4 quarters or more to ramp them up. So how are they going to expect their numbers to improve in the next 2 or 3 quarters, all right? So this is a bit of a red flag, okay? Secondly, if you have a look at the question, he talks about the sales friction, and there was a bit of churn, where my mouse is, in terms of the changing up of the org structure in the team, okay? So in the second quarter, they had a net hire of 50 sales reps, okay? But the CEO dodged the question when the analyst asked, well, what was the gross hire? So for all the people that you hired, how many people left, okay? And the CFO completely dodged the question, which again was another red flag. So this got me thinking. I go, okay, well, why would the CFO dodge the question? Okay, what is he trying to hide? So then I did a little bit more digging. Let me guys take you through what I found, and this is very interesting. Okay, guys, so as part of my digging, what I did was I had a really, really good look through their Glassdoor employee reviews, right? And what I wanted to get to the bottom of was I wanted to see just how much of a sales execution misstep there was, and just how many problems are there in the sales team, right? Because this is an IT business that relies on sales, okay? So if sales is not working, the company's screwed. And what I did was, now there were quite a few positive employee reviews, but after reading them, there were a lot of one-lined 5-star reviews, which is obviously a load of bullshit, right? So, because, like, what good is that, right? One line, good company, 5 stars, okay? Most likely fake or bogus reviews. So what I did was, I had a look at all of the most recent reviews, and when I say recent, I mean in the last sort of, 1 to 2 quarters, and I wanted to actually have a look at what portion of the negative reviews in the recent quarters came from the sales team. And what I found was, well, I found basically a bag of worms under the hood, okay? So let's have a look at some of the comments that have been said about this company. So, sales team, okay, leadership, incompetent and capable, no real sort of strategy or execution. It used to be a good company. There was a lot of good people leaving, and a lot of good people continue to leave. Okay, people are leaving every single week. What we get is we get an idea of the morale is clearly negative. Okay, the sentiment within the employees is negative. The engagement is obviously negative as well, and the comment of incompetent sales leaders with no strategy uh, keeps on coming up. Okay, so this is something that is a bit of a red flag for me. Not only that, but there were a lot of salespeople's comments around the fact that the sales targets are hard to hit. A lot of people aren't hitting the targets. The competition, which Nutanix used to be ahead of, is slowly catching up, and all of the good talent is leaving. Selling this product is not as easy as it used to be. A lot of people are missing targets, right? And so this is a constant theme. And as you can see, the dates, I mean, they're not that long ago, right? May, July, August. This really makes me doubt that this company is starting to turn things around and can turn it around the next 2 to 3 quarters, okay? And the reason being is because if we think about this, if it takes 4 quarters to ramp up a salesperson to full productivity, yet there's a lot of disruption and people are continually getting replaced, how are they actually going to ramp them up to full productivity and sell and bring in the revenue, okay? So there's a lot of, something doesn't add up. Furthermore, if you look at another question, which was rightly pointed out by an analyst, previously when Nutanix was giving guidance, it was always a range of $10 to $15 million. But all of a sudden, they've now expanded the range of 30 million between their sort of lower end and upper end of guidance, okay? And so again, you have to have a look at, well, what's going on here? And reading through the earnings call, I'm really just not convinced that management's explanation checks out. So hence why I think that this company is not a buy. All right, guys, so that concludes the video. I hope you guys enjoyed watching, and I hope that this has given you guys a little bit of insight into what I look for in terms of if I buy a stock and when I buy a stock. So if you enjoyed the video and you want to see more videos like this where we talk about things that people aren't talking about and look at and think about things that other people aren't thinking about in their investments, then make sure you hit the like button, subscribe, leave a comment. Really helps the channel grow, and it really helps me to make more of these videos for you. And if you guys have a suggestion for another video or another topic that you want me to cover, feel free to leave a comment below. Until next time, happy investing.